This video will be on how to prepare the journal entries related to Treasury stock. We are going to use exercise 11-10 for our example. This can be found on page 513 of your textbook, and we're only going to do part 1 only. So let's go ahead and read the problem. Recording and reporting Treasury stock transactions. On October 10, the stockholders' equity of Sherman Systems appears as follows. They give us common stock that has $10 par, 72,000 shares that are authorized, issued, and outstanding. So we have 720,000 total in our common stock. And what I've done is I've actually set up some T accounts so you can visually see the balance in the respective accounts. Paid in capital in excess of par, we have 216. So we have paid in capital in excess of par, 216,000. Let me add the other zero. Hit correct. And we have our retained earnings, which has a balance of 864,000, which is also on the credit side, 864. These are our balances prior to any journal entries. Next, we have our requirements for Part 1. Prepare journal entries to record the following transactions for Sherman Systems. So our very first entry will be made on October 11th, and it's for the purchase of 5,000 shares of its own stock. So let me go ahead and see if I can scroll up a little bit so we can see both screens at the same time. Okay, so we got our 5,000 shares of its own common stock at $25. So we're going to go ahead and put down October 11th. And our first entry will be a debit to Treasury stock because the normal balance of Treasury stock is debit. And it is a contra equity account, permanent in nature. So we normally use the cost method. So since we are purchasing 5,000 shares of our own shares back, the price that we actually paid was $25. So I'm going to go ahead and put a formula in here. 25 times the 5,000 shares, we paid a grand total of 125. Now, since we paid money, we're going to go ahead and credit cash for that amount. So now our treasury stock, when we post it, it's going to have 125,000 and on the debit side. So that's the first entry A. The next one is sold 1,000 treasury stock. So we're going to sell 1,000 of the 5,000 treasury stock a few days later, November 1st, and the price we're selling for is $31, which is $6 more than our original cost. So on this date, November 1st, we're going to put our journal entry date. We are going to be selling something. So we're going to be receiving cash in the amount of 1,000 shares times the selling price of $31. So we should be receiving $31,000 for our sale of our treasury stock. But the problem is that we didn't pay $31 for it. We only paid 25. So we're going to have to do the 25 times the 1,000 shares because that's our basis, that's our cost. So we are going to credit treasury stock for that amount. And because there's an additional $6 per share, we're going to use the account called paid in capital treasury stock for the excess. And that will be the $6, which is the 25 deducted from the 31. So 6 times 1,000, that'll give us the amount of excess. And we'll go ahead and see that we had a 6,000. So 6 plus 25, we are in balance. And what'll happen is our treasury stock account is going to be reduced by the 25,000, and our paid in capital treasury stock is going to be increased by the 6,000. And you'll see the normal balance of paid in capital for treasury is the same as the paid in capital in excess of par for common stock. And then that will conclude our journal entry for the part 1B. And then our final entry is sold all remaining treasury stocks on November 25th for $20 cash. So the price dropped substantially from the November 1st and even from our original purchase date. Now, because we had 5,000 to start with, we sold 1,000. The remaining balance is going to be 4,000. So the date we're going to use is November 25th, and we're going to receive cash. Now again, we're going to set our formula to be 4,000 shares times the current selling price, which is $20. So we're going to get $80,000 cash. And the treasury stock originally cost us $25,000 on October 11th. Not 25,000, but $25. So we're going to go ahead and do 25 times the 4,000 shares. And so our price was 100,000. Now you'll see that we're not in balance. So what will happen here is we're actually going to have to figure out which accounts are we going to debit for that difference. So here what we would do is we would go ahead and first see if there's any balance in the paid in capital from treasury stock, which there is. So we can use a full 6,000 from here. So we'll debit paid in capital from treasury stock. Okay, so that'll bring our balance now to 0 for the paid in capital from treasury stock. But you'll see we only have 86,000 on the debit side total, and we have 100,000 on the credit side. So we're out of balance. What? We're out of balance $14,000, right? So $14,000 is our difference, and because we've exhausted the balance and paid in capital from Treasury, we would actually debit our retained earnings for the amount, and then we would have to go ahead and take that hit to our equity account. And that concludes the journal entry for our Treasury stock transaction. So 4,000 sold here. I'll put a little explanation so in case you forgot. And then we sold 1,000 shares treasury stocks sold. And then up here we purchase 5,000. And if you have any questions, you can post in the Google Hangout. And that concludes our coverage of treasury stock.